Hey everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there and take a look, see what people are sharing. If you want to follow me at _finance, if you want to join our community, finding-value.com, where I dive deeper into all of these topics and areas, looking for potential investment opportunities and sharing them with the community, and answering your guys' questions on the weekends. Usually have a Q&A session Saturday morning or Sunday evening, and it flip-flops between Saturday and Sunday every other week. If that sounds interesting to you, if you guys like researching stocks and companies and are interested in learning about the markets, definitely sign up and try it. We do have a coupon code special that is active right now. Special is the coupon code. Type special in and get a discount on a monthly membership or a larger discount on a yearly membership. And you can always switch from a monthly to a yearly if that's something that you'd like to do for further savings. So Isabel Net, building permits. In March, building permits in the U.S. rose to 1.482 million, exceeding expectations. Historically, they tend to peak and then decline before economic recessions. And this is one of the things that I look at. Actually, what I look at is housing starts. Permits comes before the starts. So permits is also one that you can look at. You can look at these together. You can look at housing permits and housing starts. And you can see that we were up a little bit in March. Now, during recessions, this generally declines to below about 1.2. So if you start going below 1.2, you have a increased likelihood of a recession. So 1.2, you can see we dipped below 1.2 here, recession, dip in here, we had a recession. These are all dipping right before these big recessions here. So are we going to get a recession? Don't know. We'll have to continue to monitor this. Why this is important, if you guys want to know kind of the background, this is the real estate cycle. And the real estate cycle impacts the business cycle. It basically is the business cycle. And when you see a spike in unemployment, the spike in unemployment generally comes from building residential construction. Residential construction accounts for 70% of the bank loans in the system. So of all the loans, the bank loans in the system, which creates money, 70% is against residential real estate. And if residential real estate, if you see permits and housing starts decline, that generally impacts your unemployment rate in a negative way, because you start to see layoffs in the residential real estate sector for unemployment. That's why it's a leading indicator, is because housing is a large portion of the economy and provides a lot of jobs. Markets and Mayhem says, believe it or not, today's gold rally has nothing on the 1979-1980 pop. Well, 1979 and 1980 was a market-ending move. Interest rates bottomed in the 1940s, went all the way up to 1980. The biggest moves occur at the end of bull markets. So what he is doing is he is looking and comparing the beginning of a gold bull market to the previous end of that gold bull market. And I don't think that's a fair comparison. It would be better to compare today to the 1940s and 50s, when interest rates bottomed and then broke out. You can use the 10-year yield specifically. And this is your 10-year US 10-year yield to show you guys what I'm talking about. We bottomed here. I'm looking for my brush. There we go. We bottomed here in 1941. We started to break out and come out in the late 40s. So this here is similar to what occurred here right now. So our breakout today is similar to the downtrend to uptrend move in the 1940s and 50s. They're comparing this move here to the beginning move of what we have here. I don't think that's a fair comparison. Another thing that I think is an unfair comparison is that we went off the gold standard in 1971 here. So gold had a lot of pent up demand when it started to freely trade and we could buy a bunch of gold. So, of course, gold spiked during that time. And now we're coming out of the bottom, very similar to that same situation, but it was freely traded the entire time. So we might not get as strong of a impulse move higher versus, say, the 1970s. But there are things that tell us that the 1970s, there's some similarities. For instance, if we were to do gold versus the S&P 500, that ratio, we could see a bigger move today than even the 1970s. And the way some of this that I'm basing it off of is just patterns. And I took the top here, so we had a couple of hits over here. We're squeezing down. This here might just have been a false breakout, big question mark. But here's your bottoms. Here we're starting to come up. We've broken the downtrend line. And then we've got this line coming across all the way back to 1930s. If we can break through this and run, that could be a completely different outlook on the world. What does that mean? It means that gold is outperforming the S&P 500, and maybe, this is my guess, and I don't know if I'm right, but maybe we go into a resource-constrained world where the pricing of companies, where everything has to change in that world, everything. Our currencies are going to have to be, our currencies have to change, or our money systems have to change. The way that we view growth will have to change. Everything will have to change. A lot of people say, well, the price will take care of it. I think it will to some degree, but I also think that if you're mining, this is what we're mining today. So back in the day, in the early 1900s, we were finding nuggets. When I mean nuggets, I'm talking like boulders of copper above ground is what we were finding in the early 1900s. Boulders. Now we are mining dust. We are literally mining dust out of the ground. At some point, as we continue to increase demand for these materials, so you're going up at some exponential rate, 2%, 3%, whatever it is, we're going to struggle to keep up with that. And it also will increase energy consumption basically to infinity. Because if you're wanting more and more copper and you're mining less and less ore grade, your energy inputs go up exponentially. I think that's what this is doing, is it's squeezing in, and it's going to account for that. And then it will eventually break out, because copper is going to get really difficult to get out of the ground because of the ore grades of copper and gold and silver. And I think if you own the physical metals, over time, if it continues to get harder to get and more energy intensive, it will depend on the cost of energy and how easily you can extract it. So that's going to be a debate between resource scarcity and technological improvements of mining. I'm in the camp that technology will not be able to overcome the ore grade decline, because you still have to move earth. You still have to figure out ways to somehow get it out of the earth. Now, there might be ways where we can do substitutions. Maybe we do something with more carbon, like graphene or something like that. Could be a solution. There's other materials that we might be able to figure out, but that's yet to be seen, and we'll have to see how that all plays out. But I see this as a squeeze up and a potential break. And if that breaks, it could mean resource problem. It could mean a debt problem. It could mean both of those are going on, a debt problem and a resource problem at the same time. And the SPX is pretty richly valued compared to history for what I think the conditions are coming up in the future. But you know what? A lot of people think that artificial intelligence is going to increase productivity massively, and what that does to me, or the way that I view that, is artificial intelligence is making things more efficient. That's all technology has done. Technology hasn't really done anything different for humans. Humans, like, it hasn't created a different paradigm or outlook, or things that humans maybe want that didn't even know that they wanted. It's all the same thing. It's communication, traveling, eating, food, stuff like that. And it's just doing that more efficiently. So we've gotten bigger airplanes. We consume more and more energy. We communicate differently through handheld devices versus phones versus, flagging someone down. It's just, things have gotten more efficient. We can store more data in a smaller space. It's not like we're yet transporting people somehow. Maybe we can figure that out, maybe not. But if artificial intelligence is, in fact, successful, let's just say it is, that it's super successful, it means that businesses are more efficient. And what does efficiency mean? Efficiency means that they are producing more product per unit of input, whatever that unit of input is. It could be per capita, per employee, it could be per unit of energy, per whatever it is. But that also means you need far more commodities to basically pump through the system. Units are just commodities plus energy. So if AI is highly successful, what I would think would happen is that your demand for commodities would go up dramatically, because your efficiency and your productivity gains means that you need to spit more commodities through manufacturing to get final end outputs. So that's kind of where I think the future would be, is if you own all the commodities, that's what all the future wealth is. And then the designs are just an accumulation of a variety of commodities put into a design that people consume. That's it. You can call it a cell phone, you could call it a car, you could call it a bike, motorcycle, bicycle, a house. That's all it is. It's a configuration of commodities built for a usable product. Coming on, we've got Kevin Bamborough. I like Kevin. Kevin's got a lot of. He thinks very similar to me. I think we have a lot of similar opinions. He says it's crazy people want to argue price action of Bitcoin as being somehow validating. Something with no intrinsic value simply has no intrinsic value. It's not up for debate. It's a fact. Bitcoins represent a wasteful fool's claim on 142 characters. It deserves a slow clap and a laugh. Time takes care of all Ponzi schemes. Now, I don't. Rather than like putting Bitcoin down, or rather than saying that it can't exist or whatever, I just let it be. Like, I don't think it has any value, so I don't play in that arena. But that is true that everybody says, well, why does the price keep going up? Why does it keep going up? Because of FOMO. I mean, if things go up, people will continue to buy it, even though something doesn't have any value. That's what happened with every single bubble in history. That's what happened with some of the Ponzi schemes that had gone on for 20, 30 years, Madoff and all them. So it's just like our currency system. Our currency system isn't worth anything, but somehow it keeps going. So what you're hoping is that the Ponzi continues to last while you own it and you get out before the Ponzi breaks. I mean, that's really what it is. And I don't like playing in games where you can get absolutely smoked. So I just don't play in that game. I just avoid it. Yes, I won't get rich off of it. Oh well, that's no big deal. I also won't go to the poorhouse because of it. Obviously, you can put a certain portfolio allocation to it, where you get to avoid if it were to go down. You don't go to the poorhouse, so to speak. Maybe you only have a couple percent allocation to it, but still, I don't view it as value, so I just don't play with it. Kevin says I like this outlook here. He says, when we work and pay taxes, think of it as the government getting X percent. It's a tax rate of the goods and services that we produce. So, I mean, think of it as government stealing X% of goods and services that we produce. When those tax dollars flow to government debt holders, it's then like debt holders get a percent of the goods and services produced in a country. But when money is just created out of thin air and enters an economic system without work, it's purely inflationary. Everyone is taxed via depreciation of their currency holdings. In particular, when debts are paid with the creation of new money, it's a dual crime. It's loss of purchasing power on savers, and while also gifting away an obligation to repay a debt by those who borrowed and spent without work. QE will continue because there's no choice. Foreign holders of USA debt will be as pissed as they were when the gold standard was broken. Gold went up 20x then. The average guy has no clue how painful it's going to be as our government starts being forced to print their debts away. So here's another thing to think about. If you can create money from nothing, which is what the Federal Reserve does, and these people are literally stealing a part of goods and services that we produce through taxation on the interest rate of the bonds. They are stealing from the system, productivity from the system through the currency system and through the debt payments, the percent interest rate that they get on the bonds. But they printed that money from nothing. That's the whole problem. That's the root cause of the problem of the system. If you can fix that, where you don't have interest released when money is created from nothing, you fix everything. What do I mean by that? You fix the whole thing of people stealing from the system. You fix the Federal Reserve stealing from the system. You fix the debt problem that we're in because you wouldn't have interest paid back to this fictitious money. That's all gone. And that's why every single country that has a Federal Reserve Bank is in debt, because you can never pay it back. You have a more ethical system because you're not stealing the goods and services that the country produces through the currency. You also stop it from the interest payments. So you basically get rid of all of that. That is why our Constitution has developed gold and silver as money to prevent this theft through the currency. There's other things that it also prevents. It prevents government from creating money and using that money to do things where they can steal. They're literally blocked. So they can't create money and just do whatever the heck they want with it and steal purchasing power through the currency. Because if you have a design of a currency that doesn't allow money to be created from nothing, they are then blocked. Then they have to literally take it from you through taxes. And if they try to do that, you can eventually vote them out. So they can't really steal. They can't do these stupid US aid. You can't do all these things and open up and just start doing all these studies because the money doesn't exist. You can't just create it and steal through the currency. So the root cause, in my opinion, is the currency creation process and it's the design of our currency system. If you change the design, you block everyone from stealing from that design. Here's metals weekly price and performance. Palladium did quite well last week. Nickel, copper, platinum, gold, silver, and zinc, aluminum, lithium were the ones that were more towards the bottom. And what you'll generally see is these will rotate back and forth. Sometimes the best earners during a week will be next week's worst performers. I just buy whatever's cheap and is down, and I just hold on to it. That's my approach. This is tin, so silver investors. It says a lot can happen in a short time frame. The key is always to zoom out and focus on the macro setup here. Never get drawn into the daily swings. This is a very long-term bullish setup about to unfold. Global debt collapse, and this time silver doesn't come back down. That's correct. You're going to see interest rates go up. Did you know that the end of the interest rate environment, when it was peaking, was over here? And then when interest rates peaked in 1980, when did silver start its consolidation? It's the same time when interest rates went into a downtrend. Interest rates were in a downtrend this entire time here, and we just recently broke out on this right-hand side. And you know what else broke out of this cup and handle? If you do the downtrend line here, it just recently broke out when interest rates did. I think silver is going to go ballistic. Ballistic. I think gold's going to go ballistic. Why? Because nothing else in the system is going to be able to preserve purchasing power. It's going to be commodities and precious metals, and that's it. Very similar to the 40s, 50s, 60s, and 70s. And we're at a time where the valuation mismatch between financial assets and hard assets are maximized. Like this is the largest asymmetric opportunity that I've ever seen in my entire life. It was in 2020. And I still am dumbfounded that this got so out of whack. And I don't know why people don't see it. I don't know why it's so obvious to me. I don't know why others maybe don't see it. And this isn't about trading month to month or year to year. This is going to be a gigantic bull market that lasts for decades. It's going to be a big one. And it's going to go up as long as interest rates go up. And I think we are screwed with our currency and debt problem. So we could see the currency and debt problem go into a crisis. That could also occur over multiple currencies, not just one currency, which means that many countries could run at these things to preserve purchasing power with everything they've got. It will be the biggest bull market that we've ever seen in commodities, and it will dwarf everything in history because of the conditions that exist today. And those conditions are the debt problem in America being over 100% debt to GDP, which means that most likely we are going to enter a problem over the next 10, 15, 20, 30 years, potentially. Also, interest rates bottoming after that 40-year period. Also, the financial assets in relationship to hard assets are at extreme lows. They are extreme cheap for hard assets. You start to add this all up, and the potential possibility of maximum money rotation is ridiculous. Now, I can't tell you when it will happen. I can't tell you how fast it will happen. All I can say is the conditions are set. They are there for this to unwind to a level that most people will not fathom. They cannot think of it. They will tell me it is impossible. And it has everything to do with our debt situation and the value of the dollar. And then it will be preservation of purchasing power, and then money will rotate where it's going to preserve purchasing power. And speaking of overvaluation, Warren Buffett looks at market cap to GDP as one indicator for how frothy or cheap the markets may be. The S&P 500 recently traded around 168% market cap to GDP versus the global equity markets at around 90%. That suggests U.S. stocks are exceptionally expensive. And this is going back, you can see 2000 was about 125. We're at 168. It means financial assets are in a massive bubble because of the pricing in relationship to your economy. Now, I don't know when this will unwind, but I think it will unwind because of the market conditions. The market conditions and interest rates are going to unwind this thing. Quote of the day, George Soros says, when a long-term trend loses its momentum, short-term volatility tends to rise. It is easy to see why that should be so. The trend-following crowd is disoriented. So a lot of people, all they do is they follow the long-term trend. And then when things start to change, they become disoriented and a lot of short-term volatility goes up. Copy says R2K is horribly flawed as it's where failing Ponzi's go to die. Go look at the S&P 400 and S&P 600. Those are indexes of real businesses that mostly have earnings. These indexes have gone nowhere for 4 years now. My guess is that it shows how the US economy has been in a recession for that entire period. We got nominal GDP growth, but no real GDP growth. We got a tech bubble, and everyone else got left behind. Strip out SBC and tech companies, haven't even done so well. No one even accused mid-cap of being particularly expensive. They just keep under-earning mid-cycle earnings because the economy is in a recession. Hence, they can't get a value uplift. So that's Cuppy's opinion that we are in a recession, perhaps, and this is why we're seeing a lot of these other areas trade sideways. So you can see the annualized returns, 3 years, just 1.2 and 8.6 for the S&P. And that's what he's saying. It's a potential slowdown for these small guys. Here's 100 years of equity concentration. 100 years of equity market concentration. The equity market is currently near its most concentrated level in 100 years. And what that means is that we are concentrating in fewer and fewer companies. The market cap of the largest stocks relative to the 75th percentile stock on the left axis. So what I did is I took these dots here, 1932, 39, 64, and I put them and overlaid them on the SPX. And I wanted to see, where these dots were. But this is where they were. So 32, this one here, 1939, that's where 39 is. It's right in this dot here. So 32, 39, we have 64, and then 73. So these are the two there. Here's 2000. There's 2009 that they had. And this was 2020 there. And then where we are today is way up here. So that's where we are today. I didn't put a dot there. So it looked like every one of these dots was located in the commodity boom area. 2020, maybe that's early. Maybe we pop up. It's hard to say. It's hard to know when you're going through it. It's super easy looking backwards, 2020 vision. But here's the commodity bull markets. You can see these highly elevated valuations of concentration is in the bull markets of all these commodities, nowhere else. Just an FYI. Eric Yoon says, when gold was at 1,700 USD and silver was at $20 an ounce in 2022, a troll said to me, Eric, you can't go around telling people that gold and silver are good stores of value. Some people might actually believe you. Buy gold and silver and get hurt from doing so is what. So this is what you'll hear everywhere. They'll tell me that oil is a horrible investment at 60, $50 or $60 a barrel. I'm like, are you kidding me? I mean, it's as cheap as it's the second cheapest time in history, going back to the 1800s. Everyone is bearish at bottoms. That's how you create the bottom. Everyone is bullish as you go up. That's how you create the tops. The news is bullish at tops. The news is bearish at bottoms. Everyone is consumed in it. And that's why it's really hard to buy bottoms and it's really hard to sell tops. It's because everyone is convinced and the sentiment is all behind them. And they want you. They're going to make fun of you by buying at the bottom. Everyone is like that. Everyone. It is so hard to find people where they're like, oh, I'm going to buy down here just because it's negative sentiment. Very hard to find people like that. Michael Guyette said it's over. I'm rotating 100% of my portfolio to gold. This is Wall Street Bets. This Monday, I'm selling all my S&P 500 shares and buying GLD. There is no other rational asset in this market. There's a bunch of assets that look fantastic to me. But I will say this, guys. I don't buy charts. This is gold, and I think gold will go higher throughout the bull market. I just don't buy stuff that goes straight up. This is up here. Your entry point was down here. I mean, you could have bought it in here, 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 all through here. But what I mean now, just because it's outperforming, I'm going to rotate everything and do FOMO. Now, it worked out pretty well in the 2001 to 2011 timeframe. Even if you purchased it up here, you did pretty well coming on up. I think that we are going to see silver outperform gold here. I think silver is going to do something ridiculous. We're still underneath a breakout. We haven't broken out of the $35 level here. This is your cup and handle. And we haven't broken out of that key area where we start to run big. So if it were me, and this is not financial advice or anything, I would rather buy silver than gold. I do think gold's going to continue up. So I'm not bearish gold by saying that. What I'm saying is I want to buy stuff that's down. I'd also rather buy platinum that's been squeezing in this pattern here that's ready to break out. So I'm buying valuation. I'm not buying the price movement. Yes, we are squeezing in this corner here. And yes, I may have to wait a little bit longer for this to break out. The market condition is still favorable for gold at this exact moment. But that's how you make money. You buy it before the market condition is prime for the other metals to start to rip. So that's the way that I view it. You can also look at the ratios. Platinum divided by gold. It's the cheapest it's ever been in history. The cheapest it's ever been. You can also look at gold to silver ratio, and that is also at a very, very good opportunity for potential investment in these areas up here. So that's the way that I view it. EWW Mexico ETF. It's the first solid weekly close into the 25 value area. This looks pretty good. So that's EWW. You can look at it from my perspective there. So this is what you want to do. So when you get a consolidation like this here, and then it breaks, this is a good time to be looking to purchase. Much like gold broke out, look at the size of that move. It went all the way to 63, and it was down here at 18 bucks. Pretty good move in a pretty short time frame. We then went into a consolidation, the 1, 2, 3 pump consolidation. Your buy point was actually back here or down here if you're really aggressive. Those are your buy points here, and you should be riding this higher. And I think we're going to go way, way up. I think that what this will eventually look like, and I'll show you what it looks like, in my opinion, is that this consolidation and breakout will then repeat. So this will be, and we're going to go big style here, boys. We're going to go real big. This here, and you guys are probably seeing the fractal already. That fractal, do you guys see the way that it is there? That's the fractal that we're going to get there. And then we're going to go all the way up to maybe $275. We're currently trading at 54. You can see the fractal. I'm just going to yank it and put it just above so you guys can see that. It's the same fractal. This move, the sideways consolidation is the same fractal that we've got here, and we're just ready to rip. So if we were to say, where are we located in this bull market? What I'm saying is that if I were to take just the advanced move and move it higher, I'm saying that this beginning portion, I mean, we're going to go way higher here. Just the beginning portion there is where we're going to end up going. Is this move, and that move broke out. We haven't even broken out yet of this, but we're close. So that's about where we're located for that potential move, in my opinion. And that's going to occur because of a weakening dollar, because of the debt situation in America. That's going to be the main driver of that. That's my opinion there. And there's a bunch of things that indicate that we're at this location and we haven't broken out of the consolidation pattern here yet. Think of that as resistance there that we haven't really broken out. So this here is this here. And then we're going to have a big move up to another level again. So that's coming. Get ready for it. We're right there, and it's going to be the weakening of the dollar that drives that move. The greatest risk in investing is not knowing what you are doing. Michael Burry. Totally agree. Totally agree. Here's Johnny Oil Wells. He says, the wizards tell us OPEC has 5.1 million barrels per day spare capacity. Saudi has 3.2 million barrels per day of that. Saudi currently makes about 9 million barrels per day. Can someone point to the graph where 12 million barrels per day is justified? What is actual spare capacity? Hint, it's not 5.1. My gut says 1.5. What's your gut tell you? Well, yeah, so I looked back, you look back at Saudi's oil production, stable oil production. I think maybe they can get to about 10, and that's maybe where they can hold it. Maybe 10.5, maybe. 12 is off this chart. That's spike production. So they could maybe go to 12 for like a month or two. I don't think they can hold it there. So spare capacity, I think that we've got maybe, they're producing at about 9. We got maybe 1.5 million barrels. I think everyone else is tapped out in OPEC and they're cheating. They're cheating the system. Now, here's something to get worried about. If that's true and we only have 1.5 million barrels of spare capacity right now, we're still eating through our inventory. Our inventories are declining. Fair value of oil is $95 a barrel. If we don't have the spare capacity, we have lower days of coverage and inventory today than what we did in the mid-2000s. Also, if spare capacity is 1.5, we also have less spare capacity than the mid-2000s. Back in the mid-2000s, that drove oil to 150. I think we are going to a level much higher than $150 a barrel over the next, between now and 5 years. The problem will be realized between now and 3 years, but the market may take a little bit of time to digest. I think it will happen earlier than 3 years. I think it could happen over the next year or two. So the market right now is just negative sentiment. When this turns, I think we're going to see a big move. And then people are going to realize that we don't have the spare capacity. And then they're going to realize that if U.S. shale does roll over, I don't know where that oil is going to come from. Like, I literally don't know how we're going to reverse the decline in shale. So if shale starts to lose 1 million barrels per day or something like that, where are we going to get growth and the replacement of another 1 million barrels from shale? I think 2025, I think will be covered because there are some projects coming online. But after 2025, I don't know where it's coming from. So my gut tells me that we have a problem and the markets are not recognizing that problem yet. And I'm fine with waiting for them to recognize it. That's my view. And I think it's closer to 1.5, maybe 2 at most. Here's Market Sniper. He says, China has stopped buying American oil, beef, soybeans, cars, LNG, and airplanes because of Trump's tariffs, while America keeps buying iPhones, shoes, computers, antibiotics, shirts made in China. How do you think trade deficits adjust on the above? Does it, one, improve for the U.S., have no effect, or accelerates the U.S. deficit with China, thereby the collapse of the U.S. debt system as China elects to stack gold, not treasuries? I think it's number 3. We're going to accelerate the U.S. deficit with China. Now, the bigger question I have is this being done on purpose? Which I think it might be. If it's being done on purpose, what are they trying to do? Are they trying to destroy the dollar and move us into a central bank digital currency system? If that's the case, then I do not want that. I do not want that. I want to keep, I don't want, I'll just say that. I don't want that. Hopefully that's not the case. Here's silver's 100-to-1 activation point just triggered. This extreme imbalance has only happened twice in the past 25 years. What followed each time was the silver outperformed gold by 3 to 5x during the next precious metals rallies. Correct, and that's where I would be. I would be in silver. Now, some people might ask, should I swap my gold to silver? That's up to you. That's a question that you have to figure out. I can't tell you what to do, but my holdings are a certain way because I am aggressive. That's what I'll say. Breaking, he's already fired, constructively dismissed, lame duckified. The market will begin pricing in Trump's desired policy, print debts away. This is breaking news. France is warning that the president of the United States would put the credibility of the dollar on the line if he fired Federal Reserve Chair Jerome Powell. You're reading this right. I think we are out of the popcorn at this point. Yeah, we're going to print money, guys, and we're gonna devalue the dollar. It's baked in the cake already. Western Canadian select differentials remain in single-digit territory at minus 9.65, which is good for oil companies in Canada. And we're going to see the price of oil go way up too. Howard Marks says, waiting for the bottom is folly. What then should be the investor's criteria? The answer is simple. If something's cheap based on the relationship between price and intrinsic value, you should buy. And if it cheapens further, you should buy more, says Howard Marks. So I know a lot of people will tell me, we're not at the bottom. We're not at the bottom. It doesn't matter, guys. If something's cheap based on the relationship between price and intrinsic value, you should buy. And if it cheapens further, you should buy more. So you're not caught out of the equity if you're trying to time a bottom and you mistime it. You can also develop strategies where maybe you cost average in, where you buy it when it's cheap and you'll buy more if it cheapens further. So you don't put everything in all at once. You buy it, you buy it, you buy it, you buy it. Maybe you buy it on every dollar sold down. When it gets to a certain area where it's super cheap, you start cost averaging into it. That's how I approach the markets. I don't try to time it with one big purchase. I think a lot of people try doing that. Jordan, yeah, so I think we went over that one last time. So we're going to end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got that special coupon code that's active. And that's all I've got for today. So we'll catch you next time. This is Finding Value.